performance management formulas. Now, some of these you may have seen in other lessons. Some of these you may not have seen in other lessons. Why do we repeat them? Well, they're just more more relevant here. I mean, it's not like they weren't relevant in other lessons, but hey, it's never a bad time to bring these back to light. Just kick you in the butt, reminds you to memorize them all. ROI, I mean, we've kind of beaten that one to death, but it's here again. Return on anything, net income here still means net income. Return on is net income in the numerator. You got that. Return on equity is divided by equity. Return on assets, average total assets. And I mean, I hope I'm memorizing, but I also like to make a point. Be practical. Run through our questions because right here, if I didn't explain it to you and say that, oh, usually average total assets or invested capital is given to you in certain language, right? Of, oh, we bought a $100,000 machine, then that's, you wouldn't know necessarily in the questions that they do it that way. But too many times do people just study the lectures or study textbooks, and then textbooks are not like it really is on the exam, or obviously I could say in real life, but I'm not here to teach about real life. Still figuring that out myself. Right, so make sure you're practicing questions over and over, making sure to drill down these formulas. Step 1 is memorize them. Step 2 is understand how they work in actual question form. Net profit margin, net income divided by sales. We've seen this one a good amount. Just memorize that. Asset turnover, sales divided by assets, and financial leverage, assets divided by equity. Memorize these formulas, not to go into them too much, but memorize them all. They'll be your. Oh boy. Oh boy, oh boy. If you're telling me, Nick, what the heck is going on here? I don't know. I just work here. So what's going on here? Okay, well, the DuPont ROE is just it's a fancy word, fancy name. It's just called that. Just roll with it. And then we got an extended one, don't we? That's even better. And all this is just breaking. It's got a formula, and then of these components in the formula, it breaks them out even further. And we saw a bunch of these on the previous slide. So net profit margin, we know net profit margin equals net income divided by sales, and asset turnover, we know that equals sales divided by assets, and financial leverage, we know that is assets divided by equity. So you see here, it's just, again, you could get a multiple choice question. It does happen plenty on the exam where it gives you sales and equity and costs, and you have to figure out assets to find, and then you'll find ROE, right? It gives you a bunch of numbers, and you got to do a couple extra steps to get to your final ROE number. Now, on the test, it's not going to say find the DuPont ROE. It's just going to say find the ROE, but it's just called this. It's just called this, and everywhere else, and it's mentioned. So if I didn't include that, someone would throw a rock through my window. But haha, no one knows where I live. So the DuPont ROE equals the return on assets times financial leverage. I mean, again, just so many ways to rewrite all of this. So as you can see, ROA, return on assets, is net profit margin times asset turnover. Make these connections, and you'll get it. Now, if you didn't think the DuPont ROE was extended enough, we've got the 4-hour extended Blu-ray edition with director's commentary. Well, this is the tax burden times the interest burden times EBIT margin times asset turnover times financial leverage. So, okay, you might think, well, this is the same, so this is what's different. Let's talk about this for a second. That was a little sloppy. Although, good thing my content is not. So, what is this? Well, think about this. Earnings before interest and taxes times interest times taxes. Nothing crazy. And then that's net profit margin. So earnings before interest and taxes. So this is earnings after your costs and all that. And then here it's just taking into account interest and taxes. It's just broken out because, well, the AICPA hates us and wants us to just earn in formula hell. But also, yeah, I mean, it's just, actually, I don't have a reason other than that. That's pretty much the reason. So yeah, memorize the formula to answer their questions and move on with the exam. So that's, tax burden, net income divided by pre-tax income, and it's pre-tax income divided by EBIT. EBIT margin is EBIT divided by sales. So these all correlate with each other right there. Memorize them. This whole extended one, less important than just the normal DuPont ROE. This I would for sure know, but man, it's a whirlwind, isn't it? To wrap this joyous part up, our interest burden to elaborate on that further. And if you want to take time and just kind of look at these more than what I'm just talking about them, I mean, that's kind of how I made these connections, is just sitting here and in my study and just meditating over these formulas. No, but you sit here and just look at them and think, okay, pre-tax income. Okay, like think about that. I'm visioning an income statement, right? What hasn't it taken into account yet? And then earnings before interest and taxes. Okay, so pre-tax income, it does take into account interest, but not taxes. Earnings before interest and taxes. So this takes into account interest. This does not take into account interest or taxes. Neither of these takes into account taxes. So this is income with interest, income without interest, and right, just dividing them by each other, and that'll give you the percentage of a burden. Gosh, because costs are a burden. I know that goes with interest. That interest puts on you. Nothing crazy, nothing crazy. So I definitely would recommend just sit here and go through each one. Think about it. Sales divided by assets. Assets divided by equity. Right? EBIT margin. Earnings before interest and taxes divided by all of sales. So what portion do you get to keep of your sales, really? What margin do you get? Think about it. Margins. Oh, you want to have good margins. You probably hear that a lot. But what does that look like? I just cleared these and put them back. We're not done yet. We're just wrapping this up. Actually, yeah, I mean, these are pretty much, we can wrap it up because this is back up here. This is up there. Just to put it a little bit down here and break it out for you. Memorize all these formulas. Think about them. Meditate on them. You're not doing too much meditating already. Self-care. Remember self-care. If you need a stretch, go take a stretch. If you need to go for a jog, please do so. And listen to these lectures as you're going. But take care of yourself. Let us run through a wonderful example on some formulas, likely formulas we saw, likely pulling from other formulas that we've seen. Keep those formulas sharp and fresh in your mind, right? Have a sheet with you at all times where you're constantly pulling it out and writing all the formulas out. Trust me, writing them out, being able to write them out is much better than just saying, oh, I'm staring at it and I memorize it. Like, that's the ultimate way to know if you really know it, is just write it out. Now, what's it asking for? What's our ROE? As we saw, oh man, there's a million different ways to get that ROE. In this case, well, we will see. We had sales of 2 million, profit margin of 11, and assets of 2.5 million. Now, Spear decided to reduce its debt ratio to 0.4 from 0.5. Okay, here's where I'd start to say, write out your debt ratio, because it gives you quite clearly what's going on there. By selling new common stock and using the proceeds to repay principal on some outstanding long-term debt. But after this refinancing, what's refinancing? Well, we are refinancing our debt, right? We're selling new common stock, paying down our debt. Couple things. Again, write out your debt ratio. And what is your debt ratio? It's debt divided by assets, liabilities divided by assets. We've also got a lot of mention of debt, assets, and equity, which leads me to think about the accounting equation. Now, if you are saying, hey, Nick, I know you tell us to memorize all these formulas, but it seems like you're just, pulling from what's given here. I mean, yes, I am. I'm skipping the steps where in my own head I would think of other formulas and cross them off, right? So, but then that's just for the sake of time. You guys don't want to hear me ramble and think about formulas that don't matter here, right? But for example, I'd say, okay, debt ratio, what's the profit margin ratio, right? So what are some other ratios that we might have to think of? Yes, I mean, in reality, if I didn't have this all printed out in front of me, I'd be thinking about those and writing them out and then eliminating them, saying, okay, I probably don't need this formula or this ratio. So I'm not a hypocrite. At least I hope I'm not. If you think I am, that's an opinion you can have. All good. It's not all good, but do with it what you will. All right, so we're given the debt ratio. We've got that here. Current profit, we'll need that in a bit, so hold off on that for now. So using the accounting equation, we know total assets equals liabilities and equity. And if you don't know that, please, man, where to start? Just go through and learn some basic accounting. So we can say the debt ratio equals total liabilities divided by total liabilities plus equity. And how do we know that? We do a little arranging because debt is up here and it's divided by assets. And what is assets? Assets is debt and equity. See the magic there? That's just that. Ooh, that's a little sorcery we did. But right here, since it does give us asset amount, we are given that here. Its return on equity before the refinancing is, how do we do that? Return on equity is net income, which is essentially just profit, right? Profit margin times sales gets us to our net income of $220,000. That's our numerator, right? That's our numerator right there. And well, before we had a debt ratio of 50%. So our asset amount of 2.5 million times 50%, that's going to get us to our, well, that's 1,250,000, and 220 divided by that amount gets us to our return on equity of 17.6. Now, this is before the refinancing, which we will then use to calculate after the refinancing. So the return on equity after refinancing is equal to, okay, fine, we didn't actually need it. What we do here is we take the 0.6, so debt ratio is, and you can make up numbers here. So what would get us a debt ratio? I'll make up some numbers. Let's have some fun. A debt ratio of 0.5. Maybe you have $50 of debt for $100 of assets. Awesome. So that would get you a debt ratio of 0.5. Now, okay, how do we get a debt ratio of 0.4? We would say 40 divided by, because we don't have any change in assets. We know that because all we're changing is debt and equity. So this is what's happening next, right? So we know that the assets are going to stay the same, and the proportion, and assets equals liabilities and equity. So the proportion that is allocated to equity is now 60%, because 40%, so before it was half and half, right? The accounting equation was 2,500,000 equals 1,250,000 of debt and 1,250,000 of equity because of the 50% here. Now that debt is only becoming 40% of the equation, equity is 60%. 60% of 2.5 million is now our equity amount. Do 220 divided by that amount, and that gets us to our final answer of our new 14.7% after the refinancing. Now, this one was an absolute doozy. I will give you that without a doubt. There's a lot of moving parts here, right? It's kind of wild, and it's a good one to practice. If you got to go back and rewatch this again, right? Make all these connections, have those synapses in your brain fire in, and get familiar with it. This is a super solid question. Are they all going to be as difficult as this? Probably not. But if you can do this one, if you're making those connections, then I think you are in a good spot. All right, let's keep moving along here. Less numbers, and if anything, zero numbers. We just got a little bit of number of shares going on. Okay, so in analyzing its current year operating performance, Merle Company determined that its return on assets improved significantly from the prior year. Good job. Everyone gets pizza and a trophy. Total assets and operating expenses were stable, and overall debt decreased while net earnings increased due to greater sales volume. An additional 50,000 shares of common stock were authorized during the year. What is the solution? There's not really a question prompt here. This is just us talking about it. This is based on a multiple choice question, right? It would say, like, what was true here? Well, what's true here is that Merle made more efficient use of its assets. And how did Merle make more efficient use of its assets? Well, the formula for the return on assets, and this is mentioned here, right? Return on assets. So you see that. I'd write out a formula. It's net income divided by total assets. And play around with numbers. Whenever you have a formula and you're just thinking about it, create some fake numbers if you want. So how do you improve this? Now, I'm just doing this because I don't have to write out the numbers, but you could say, okay, net income's 100 and total assets is 50. So you could play around with that. Your return on assets is 2. You could then, how do you increase your return on assets? Well, we either increase net income, we decrease total assets, which is making more efficient use of the assets. So that's also true. We could have made more net income. Does it say anything about that? I don't believe it said. Overall debt decreased while net earnings increased due to greater sales volume. So, yep, that would be a possibility as well if we increased net income. So, but that it just says net earnings, not net income, which would lead me to possibly second guess that if that were an answer. This is more of just a discussion thing. We're not really like looking for a precise answer here. Or decrease the so we increase the numerator or decrease the denominator. This would mean that the firm makes more money relative to the assets it has. So you could also say this, right? Inflows and outflows. We want more inflows and less outflows. The question indicates that there was no change in assets. However, net income increased, so the firm was more efficient with its asset usage. Awesome. So assets were stable, right? So this did not change. However, this increased. So we made more efficient use of our assets. That's how we would determine this. Think it through. This is a very much more diving into a ratio or formula and thinking about it in terms of real practical use. Perfect, awesome there. Let's keep moving along. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.